Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 254 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark.
How are you doing this Thursday morning?
Doing good. Kids are last day of school today here.
That's right. It's
in
that
Oakwood,
time of the year.
They're excited for the summer. So there's a lot of happiness and enthusiasm at the Jessup household these days.
Yeah, I'm sure. Yeah, unofficial start of summer with Memorial Day last weekend. So I'm sure they're very excited.
They're very excited.
As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on May 29th. S&P 500 index up 4.6% for the month and up 10.4% for the year. The Dow Jones Industrial Average up 1.7% for the month and up 2% for the year. The NASDAQ Composite Index up 8.1% for the month and up 12.7% for the year. The Russell 2000 Small Cap Index up 3.2% for the month and up 0.7% for the year. And the Vanguard All World Ex United States ETF up 3% for the month and up 4.9% for the year. 3-month Treasury rate at 5.46%, the 2-year Treasury rate at 4.96%, and the 10-year Treasury rate at 4.61%. Big headlines, current events from this week. Matt, this was from Capital Trades around cryptocurrency.
Okay.
So the House approved the Financial Innovation and Technology for the 21st Century Act, or FIT21, making a significant legislative win for the crypto industry. 71 Democrats joined 208 Republicans in support, despite opposition from President Biden and SEC Chair Gary Gensler. The FIT21 Act aims to regulate digital assets, designate the Commodity Future Trading Commission, or the CFTC, as the lead regulator for non-security spot markets, and clarifies the classification of crypto tokens as securities or commodities. This marks the first major crypto bill to pass a chamber of Congress, but its future in the Senate remains to be determined. So any thoughts on this? I know obviously crypto's been back in the news recently with some ETFs launching and gaining a lot of popularity, as one might expect, but any other thoughts you want to add to this?
I just think it provides more clarity for people, and I think if there's formal legislation on it, I think you could see more widespread adoption amongst, say, the financial services industry. And I think that's the biggest thing that could happen. It's just formal regulation, formal legislation on it, right? And they're appointing now, designating who would be in charge of the compliance, the CFTC, which makes sense to me. I'm still for the most parts on the sidelines on this one, and for the most part. So yeah, just interested to see how this progresses. I don't feel this is going to get through the current Senate that we have today.
Right.
If the Senate flips more on the Republican side after the upcoming election season, then I do think something like this would happen.
Right. Yeah.
That makes sense.
Yeah, and that's a good point to clarify. It was passed by the House, but still needs to go through the Senate process as well. So it could take some time before this is formally approved.
One last comment on the topic. I did hear that Trump was campaigning over the past week and was saying that he was for formal legislation about crypto and he was against a digital dollar currency.
Interesting.
So that was interesting. He came out on those two stances.
Yeah, very interesting. Yep. Okay. Well, more on that, I'm sure, in the coming weeks and months. Moving on to tweets, articles, and research from this week. The first thing I had was a tweet from Morgan Hausel on May 23rd. And he says, at every point on this chart, you could have made a plausible case that the future was dim, the young generation was lazy and politicians were screwing everything up. And Jenna will throw this up on the
Pick
YouTube
your point
video.
of the chart. Pick your point of the chart.
And it's just a chart of the S&P 500 total return going all the way back to, it looks like 1871 through 2015. And it's just a good long-term reminder that, there's always going to be people out there saying the economy's the worst it's ever been. We have global wars going on. Politics haven't been this bad ever. So on and so forth. But as you can see, this chart clearly moves from the lower left-hand side of the chart to the upper right-hand side of the chart.
Yep.
Again, just showing that, you're going to hear a lot of noise, but at the end of the day, investing in the stock market is a pretty good deal for most people.
Yeah, I think historically they'd say on Wall Street, what's one of the most expensive terms? It's different this time. You're going to go through instances that might not be the exact situation, but there are going to be, there will be dark days ahead, right? But the market always finds a way through those dark days.
Yeah, exactly. And these are just 3 things that Morgan pointed out. You could add another 200 items.
Oh, yeah.
That people talk about all the time.
I love that you highlighted this, by the way.
The debt's as high as it's ever been. Credit card debt for consumers is the highest it's ever been, so on and so forth. And you keep hearing these.
We haven't seen interest rates as high on mortgages in 30 years, 40 years. Yeah.
And you're going to keep hearing these tales over and over and over again. But up until this point, the market has weathered all of those storms.
Yes.
Next thing I had was a tweet from Ryan Dietrich on May 20th. So again, this shows a chart of the Dow, and it's in regards to the Dow hitting 40,000 for the first time earlier this month. So Ryan says the Dow has been higher 1, 3, 6, and 12 months later every single time after previous 10K milestones. 1 year after 10K, up 10.2%. 1 year after Dow 20K, up 31.5%. 1 year after Dow 30K, up 19.1%.
Very interesting.
Bottom line, don't fear 40,000. So,
and you look at those year-to-date returns, Dow's up 2%.
Right. Exactly, with still over half a year to go, right? Or almost a year now until we're a year away from the Dow hitting 40,000. I know that the Dow has struggled relative to some other indices that we track weekly, monthly, and yearly for listeners. But again, it's one of those things that you've probably seen on the news that the Dow hit 40,000 and people are making hats about it. And
I knew I was going to say something.
All song and dance.
About the hats and the glasses on the floor.
Yeah, and I'm not saying it's a good or bad thing. I think, if an outsider looks into this and is reading about this, they're like, oh my gosh, it's at, 40,000. I remember when the Dow was at, 8,000 way back in the day, right? They're like, how can this keep on going? But, this is over a long period of time. And as we just discussed in the previous note that I had, it's going to have its ups and downs.
That's right.
If I were a betting man, I would assume that sometime over the next several years, the Dow's going to hit 50,000 and then it's going to hit 60,000.
Yeah. What's one of the wonders of the world? Compounding interest.
Yeah, that's right. That's right. So just an interesting piece since that's been in the media recently. The Dow recently dipped back below 40,000, but again, I think over the next couple of weeks and months, and I think before the end of the year, we'll probably be back above that 40,000 line.
I have a teaser for next week. I'm already working on my notes for podcast 255. I have a piece that I'm going to educate our listeners and viewers about the difference between the S&P 500 index and the Dow 30. And I think it'll be very enlightening for our audience. Yeah,
it's going to be interesting because, throughout history, the Dow and S&P have tracked pretty closely to each other. But this year, at least in my mind, this is the first time there's been this big of a divergence in terms of performance between the S&P 500 and the Dow. So yeah, interested to see what you have to say on that.
It'd be a fun piece.
Last thing I had was a tweet from Steve Deppie on May 17th, and he is a CMT. So Steve said, the S&P 500's on pace to finish the month of May at a new all-time high monthly close and higher by 10% through the first 5 months of the year. After such a strong start to the year, what can the S&P 500 possibly have in store for the remainder of the year? A lot, actually. And there's kind of a lot going on in this Excel graphic that Steve posted, which will be on the YouTube page in our show notes. But again, to clarify, these are all the instances of the S&P 500 being up 10% through the first 5 months of the year and closing the month of May at a new all-time monthly high close. Okay. So the thing that I want to point out is that the average return 12 months from both of those items occurring is 16%. So again, just because it's been a strong start to the year, just because we're hovering around all-time highs, does not mean that the market can't march on forward through the rest of the year and 12 months from now.
Got it.
So the data seems pretty strong across the board.
Yep.
It's been higher 100% of the time in these 10 different instances when we've had a strong start to the year and May closes at an all-time monthly high. So really good piece. I think listeners know by this point that me and you love data, and this is the data that I like to see. Obviously, there could be some volatility over the short term within that 1 to 6 month period following this occurrence, but the longer and longer you go out on the time scale, the better and better the returns tend to be.
Yeah. Also, kind of what makes me think about is you're going to have drawdowns during that period, right? Mm-hmm. So we've talked about it before on the podcast. I think if you slice and dice the data, you're on an average year, you're going to have 3 sell-offs of at least 5%, right? And so expect that. That's a part of investing. And so I just throw that out there because when we are in these lower volatility environments right now, and we get a 5% correction, what have we been saying on the podcast? It feels worse than it actually is, right?
Yeah.
But it's normal.
Right. That's all I had for this week, so I'll turn it over to you.
All right. I got 3 bangers this week. My first one has a lot to do with AI and data centers. Okay. Now, this is an angle that I haven't seen talked a lot about, Mark, so I'm going to be curious to see your response to this. This is a Twitter post by a gentleman by the name of Kevin Stevens. He's associated with a company called Energize Capital. Okay. And this post is from May 23rd. And he was highlighting 4 data points in regards to the, quote, data center story, okay? And I want to highlight a couple of things. First is the chart that he had. This will be in our show notes and all of our social media sites. Jenna will put this up for our YouTube viewers. And what it shows is the power grid's needs in regards to roughly the next decade is what I want to highlight. And what he said is we need 4 times the available copper and aluminum to meet the demands of both the energy transmission and the creation of data centers. So as you look at this chart, the reason I'm highlighting this is I haven't seen a lot of comments about this. I highlighted on the podcast a couple of weeks ago that there's been forecast that today AI usage, power usage of the entire power grid in North America is somewhere between 1 to 1.5%. There are projections, Mark, in the next 6 or 7 years that could be in the low double digits, which is just astonishing when you really think about it. But then you got to think about how they're going to build all this infrastructure out. And guess what? You're going to start needing some raw commodities we haven't talked about in a long time that are going to be in demand. Copper, aluminum. And this chart illustrates that. But look at the demand outside the U.S., right, in places like India. The next chart he showed, which I thought was interesting, is U.S. power sector capital expenditure needs to grow from $150 billion here in 2024 to almost $450 billion a year in 2034. Again, it's highlighting you're going to need a massive expansion of the power grid one way or another, energy production, transmission, etc., over the next decade. And again, everyone's talking about AI, but this is one of those fun factors where you start thinking about what is the domino effect? Where else is there going to be expansions? No one's talking about this. Make sense?
Yeah, for sure. And I mean, we follow a basket of commodities relatively closely, and copper being one of them. And, copper tends to be a leading indicator for the broader economy, and copper has been really strong as of late. So it's just interesting to read this and then look back even just year to date on the performance of some of these key commodities that are going to play a role in this power grid expansion for AI over the next decade. And it's like, oh, okay, it does make sense that commodities are turning up because they're going to be in higher demand over the next decade.
Yeah, and it's interesting. I talked about, I did a little further research, and they tend to put these data centers in very close proximity to the energy plant because they don't want to lose as much transmission. His fourth point to save time, and I'll quote, moving data cost 30% less than moving gas and 90% less than moving power. Proximity to power is the leading indicator of where future data centers will be built.
Yeah, and I think another interesting note to point out is over the past couple months, utilities have been kind of abnormally strong.
Yep.
And I think a lot of people are scratching their heads and they're like, well, S&P 500 is up like 10% this year, and why are utilities doing so well? Don't utilities usually outperform during bear markets or times of volatility?
Yes.
And while that's the case, is, this new technological revolution, I would call it, that we're going through, it's going to require a lot from these utility companies,
well
right?
Said.
So again, thinking about utilities and commodities, it makes sense why those two areas of the market have been so strong in preparation for all of this build out of the power grid and expansion of technology.
Well, what's going to happen is wait for the Barron's article a year from now, 2 years from now, where the front of Barron's is going to be this topic, and this is why you listen to the Independent Advisors podcast.
Yeah, absolutely.
Forward lookers on this.
That's right.
All right, next topic. Good start to the year. How much more can it go, right? You see a theme here. You constantly get inundated with these headlines, listeners and viewers, that market's at a high point. So this is a piece from Charlie Bolello on May 22nd. And this is what it says. The S&P 500 is up 11.6% in the first 98 trading days of 2024. It's the 19th best start to the year, going back to 1928 for the S&P 500. Jenna will put up this chart for our YouTube viewers. It'll be in our show notes. Mark, you're going to see a data set of 19 other times when this occurred. And you're going to see that of those 19 other times, 3 of the 19 instances, the market was down for the remaining part of that year. But you're going to see on average that the gains continue. And this just adds to what I had last week in the podcast, where I talked about going back to 1988 on the S&P specifically, Mark. When you make investments at any new high watermark compared to investing at any point during that period going back to 1988, guess where the returns were higher? When you were investing at an all-time high, which just seems so counterintuitive. And I get that. But that's just where the data stands.
Yeah, for sure. And this is interesting data. Back in 1933, the first 98 trading days of the year in 1933 was up a little more than 46%. That's like almost averaging 0.5% per day.
That's
for the
insane.
First 98 trading days, which is crazy. So,
and then what did it do the rest of the year? Tell them what the data says.
Then it was down 1.6% for the remaining 90 or day 99 to the end of the year, but still finished the year up 44.1%, which is very interesting. So yeah, strong piece of data that, when years start off good, they tend to end pretty strong as well.
Well, this next piece, I'll be interested to see what your reaction is as well. Okay. This has to do with, quote, large intraday sell-offs. What does history say about this topic, Mark? This is a piece from Bespoke Investment Group, some raw research from May 24th, and this is what the piece said. The S&P 500 index opened on May 23rd, making a new all-time high for the index, then sold off throughout the day, finishing down over 1.3% from its intraday high. Now, here's a chart illustrating this. Jenna will put this up for our YouTube viewers. This will be in our show notes. It shows the market opening up that morning, making the new all-time high, and then selling off over 1%. Why are we highlighting this? Since the inception of SPY, which is an ETF that tracks the S&P 500, not a recommendation for or against that ETF, but this is what Bespoke was illustrating. They said, and I quote, "Yesterday was the 55th time the S&P, or the SPY, traded at a 52-week high on an intraday basis, Mark, and finished the day down more than 1% from the high. There have also been 3 occurrences in the last year alone, and the chart below illustrates the performance of the S&P since its inception, with the dark blue dots indicating each of the other prior 55 reversals. Over the last 30 years, there have been no pattern as to when reversals have occurred. Yes, there were similar reversals just before 2021, 2007, and 2000 peaks, but there were also many more occurrences in the years leading up to each peak." So you're going to see that chart that Jenna's put up, that you're going to illustrate that. And then here's the most important one. It goes on to say the next chart summarizes the performance of the S&P, the SPY, following those 54 prior reversals, and compares it to the average return of the SPY on all those periods since 1994. Looking at the results, forward returns following reversals, like what occurred on May 23rd, were better than the average return for all periods since 94. That doesn't necessarily mean the SPY will see above average returns in the year ahead. Still, it also provides evidence that reversals, like you saw on May 23rd, aren't as scary as they might initially seem. So you can see the data, market making a new intraday all-time high, then sells off more than 1% through the day. That doesn't necessarily spell doom in this data set. And it's just another point that if an investor is considering putting money to work for the right reasons, long-term goals and objectives, right? And they see these headlines and, oh my gosh, making a new high and selling off 1.5%, I'm not going to touch this market. The data doesn't back it up.
Yeah, and I think it's important to separate, these occurrences with occurrences where the market opens up really strong in the morning and sells off for the rest of the day when we're in a bear market. But in this instance, we're in a bull market, right?
We are.
So that'd be interesting to see the data set on when the market opens up really strong in the morning and sells off throughout the rest of the day when we're in a downtrend or a bear market. And I'm sure those forward returns are a lot more negative than compared to if this happens when we're in a strong market, right? Because that's kind of one of the things that we look at as investors for a reversal, is that when we are in a bear market, we'd like to see the market opening up weak and rallying throughout the day into the close. That's one of the things that we look for when we're like, okay, hey, are we getting close to the end of this sell-off or the end of this correction?
Well said.
And that's what we saw when we ended the sell-off back in October of 2023, that started and kicked that rally off for the next 5-6 months.
Correct.
Into 2024.
Well said.
So, I think when, all listeners need to know is that when this happens in a bull market and we're close to making all-time highs or have made all-time highs, it's really nothing to be concerned about. So it's just interesting when certain things happen in different market environments, they mean different things.
Correct.
So you can't just say, hey, whenever this happens, the next 6 months are going to be, plus or negative XYZ percent. Really interesting data, but that's kind of how I look at it and what was my first initial reaction when you were talking through some of this stuff.
Great. Well, we're going to skip the financial planning topic of the week to save a little bit of time. I got a couple things I'd like to share with our listeners and viewers. First is the podcasting host that we use for the program. We use Blueberry. And so if you want to create your own podcast, make sure you use the promo code JessupWealth to get your first month Blueberry podcasting hosting for free. That is spelled BLUBRRY. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with the promo code JessupWealth. That's all lower cases and no spaces. And in addition, if you're looking for a piece of AI software to help you take notes, summarize a meeting, and plan your tasks, we highly recommend Firefly's AI software. You can use the link in the show notes to purchase your subscription and make life a bit easier. We use it for the summarization of our podcast on a weekly basis now. Mark, before we sign off with episode 254, any closing thoughts for our listeners and viewers?
Yeah, just clients will see this in our monthly market update newsletter here in the next couple of days. But we are entering June, obviously, right now.
Yep.
And one thing that I wanted to point out is that in 2023, in the summer months, so specifically June, July, and August, we had really low inflation readings. And when I say inflation, I'm talking about CPI. So unless the CPI readings come in extremely low over the next 3 months, you might see an uptick in inflation because it's comparing June of 2024 to June of 2023.
Well said.
And it's a tough comp, right? So when
Tough
inflation
comp.
came in really low last summer, artificially, probably 2024 is going to seem like inflation is reigniting, even though it might not necessarily be doing so. So
that
might
could fit the narrative of some of the doomsayers.
Yeah, so that might be in the headlines that, oh my gosh, inflation is spiking back up over the summer just because, last summer is really when inflation started cooling down. So I just wanted to point that out, that you're probably going to see that in the media over the next couple of months. I personally don't think it's necessarily that big of a deal. So I'm going to be interested to see what those numbers come in at, but I would not be surprised if it seems like inflation is ramping back up again, where in reality it might not necessarily be doing so.
Love that you're highlighting this. I know that we're going to get, I think, some PCE, personal consumption expenditure data tomorrow, if my memory is correct, at the last trading day of the month. And again, this is why listeners need to listen to the very end of the Independent Advisors podcast, because that is a very key point that I think could be a narrative in the market. And let's say it leads to a sell-off, that could be a buying opportunity potentially for people that are underweight risk. Mm-hmm. Love it.
Yeah. So, but that's all I got.
All right. I don't have anything special. So everyone have a great upcoming weekend, and we will be back next week with episode 255. Take care, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.